This is Dr. Craig Lemoine at the University of Illinois, and we're going to dive into 3 portfolios that are set up using the nitrogen wealth tool, and we're going to explore some dynamics of diversification and alternatives. So let's get started. I've created 3 different looks for a, let's say, 40, 30, late 30s, mid 40s investor. The first is an 80-20 portfolio. So we've got stocks, we've got bonds, but I also put a little bit of cash in the thing, and I put cash in it just to experience the drag that mutual fund investments might have. Also, other cash that might be in that position or account. So I've got 5% cash, and then you can see 77 equity, 18 bonds, and that mimics an 80-20 with some cash drag in investments. The second model I took a look at is I said, well, let's go ahead and toss in some international options too. So now instead of 77 in equities, we've got 47 and 30 respectively between domestic and international. And I split the bonds down the middle between domestic and international. So 9 and 9% accordingly. I kept the 5% cash for the sake of consistency. So we're going to take a look at that model as well, which isn't necessarily alts, but does introduce some international investing. And last but certainly not least, we've added an alternative model. I've added Bitcoin, farmland, real estate, oil, had a lot of fun with this one. And so you can see that, equities position was a bit reduced, and we've got the bond positions there, international stocks, international bonds, land, corn. A corn ETF is a proxy for ag future commodities, Bitcoin, gold, oil, real estate. So we've got a little bit of those thrown in as well, with the vision here to take a look at how they play from a risk perspective. So let's hop over and take a look at that first one, that boring 80-20 portfolio. And when we use that tool, the nitrogen tool, I want to kind of skip the trailing returns because those are just a 5-year return. But if we go to a 10-year period, it's kind of fun to take a look around. And I want to highlight a couple of things to you. Over a 10-year period, what is this 80-20 portfolio doing? Well, over 10 years, we've got about a 13.5% standard deviation. The markets has been 17, so that shouldn't shock anybody. And just as a benchmark, 60-40 is 10. Again, not really surprising to anyone. A ratio I'd like to hit on right now is called the Sharpe ratio. The Sharpe ratio is return less risk-free over standard deviation. That's a lot at once, but Sharpe ratio is really just a way of saying, hey, on a risk-adjusted basis, how did I do? Higher is usually a little better with Sharpe ratio. So when we take a look at Sharpe ratio here, again, it shouldn't be a surprise to anybody. I've got some extra cash in that portfolio, smooth the volatility a little bit. And so what we're going to say is, look, 6.67, 0.69, kind of apples and oranges there. But the standard deviations, of course, 100% market's more risky than this portfolio. Right? So that's really the first thing I wanted to look at. And so now I'm going to put in the international portfolio, and we can see how this starts to change just a little bit. So we can go to accounts, we can put the international in, we can take out the domestic one, and then let's take a look at it and see how it does. All right? While it's running, international markets over the last 10 years haven't been great. And I think we see that immediately when we take a look at the trailing return numbers and we go, oh, those weren't quite as high as last time. But let's go to our 10-year. And again, this isn't about returns. We're starting to look at modeling risk and allocation, but we can see with the international positions that we just didn't do as well. And I think that's a lot of global markets talking. But you can see that we've got this planning element here. And now I'm going to, for the first time, share the sort of diversification graph with you. This diversification graph is one of the things I really love about nitrogen, and it shows you more correlated assets being in dark green and less correlated assets being in blue. And so you can look at this matrix and say, well, are we getting much diversification by putting an international in the picture? And so just by looking at the graph, I would say, well, you're probably getting some, but you're not getting a ton. So when we open up the S&P, we can see international stocks about 0.88, so pretty highly correlated, right? And we can see that sort of large correlation. It's also a percentage of portfolio is how big that slice of the pie is. And so, yeah, we're getting a tiny bit, but when we look at international bonds and domestic bonds, you get more correlation there, more diversification. of this portfolio. Nothing too fancy or sexy happening, but it is a little bit of fun. So now what I want to do is I want to show the portfolio with alts, and then I'm going to make the case that I think is an important case in conversation to have here. So we're going to leave everything the same. We're just going to have that portfolio of alternatives in place of domestic or kind of domestic plus international. And I want to kind of go over a few things. First up, we don't really care about return. It's weird to say, right? But this conversation is a lot more about risk and diversification than it is about how we did. So let's go ahead and scroll down and see what's going on. It just happens that our alt portfolio did perform as well as the S&P over 10 years, and so that's kind of exciting. But let's look more at the diversification, and I think this is what I want to hit home on. First thing we said a few minutes ago, Sharpe ratio is that return minus risk-free over standard deviation. It is the risk-adjusted return of a portfolio, and look what starts to happen when we put other non-correlated assets that have done well into this model. We got a Sharpe ratio of 0.9, standard deviation of 12.5, and why is that relevant? Our standard deviation of 12.5, we had this almost near same returns as the market over that time period with much less risk to get there. So let's take a look at the underlying standard deviation components here, and here's what we've got, right? You've got the S&P, you've got bonds, international bonds. We used a land REIT, ag futures ETF, and you can see each of these things on their own, a kind of interesting dynamic, right? 30% standard deviations here. You've got 70%. I put some Bitcoin in the portfolio, right? That's huge. That's crazy. So why then is the standard deviation lower? Why on earth and how have we created a portfolio with this booming return, but yet lower standard deviation? And the answer to that, friends, is how these assets are correlated with one another. What we've really done here, if you look at that allocation, is you started to create a model where you have some really complicated dynamics going on within how alts are relating to stocks, how alts are relating to bonds, and how these alts are related to one another. So that allows us to build this awesome portfolio, push that Sharpe ratio up, keep the standard deviation down, and be very market competitive.